Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Best Buy is a retailer that seemed to be on the road to recovery even before the pandemic started. And then there was a lot of tailwinds during the pandemic from people who wanted to buy electronics and get their goods that day. Like other retailers like Target, Best Buy seemed to fit a lot of people's needs. But as we've come out of the pandemic, it's become clear that Best Buy is not retaining the customers that it once was. So I want to dig into the recently reported results and show exactly what the trends are for Best Buy, because I don't think they're as positive as investors might think. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And I'm going to start straight with the report here. This is results for the fiscal year 2024's second quarter. These results read right to left. So the left column here is the one that we're going to focus on today. You can see that revenue was down 6.2% on a comparable store result, $10.3 billion to $9.6 billion on an enterprise basis, and the domestic segment was down from $9.6 billion to $8.9 billion. Across the board, there was negative comparable results, but the company did report better than expected earnings of $1.25 per share, down from just $1.35 per share. So management was expecting some of that decline in revenue. They've actually done a really good job managing Wall Street's expectations so that this wasn't a big surprise. If we look at guidance for the full fiscal year, you can see that results are continuing to get even worse. This is the revenue guidance. Management said that they now expect $43.8 to $44.5 billion in revenue. They just lowered the top end. The bottom end of that range stayed at $43.8 billion, but now the top end, instead of being $45.2 billion, is now $44.5 billion. Comparable store sales are going to decline 4.5% to 6%. So that's a pretty sharp decline for a retailer. Now, we have seen retail sales decline for a lot of different retailers, but typically the decline is in the low single digits. And a lot of companies are actually maintaining a lot of the increase in sales that they generated during the pandemic. I mentioned Target. Same thing goes for a company like Home Depot. Best Buy seems to be in the opposite scenario, where they're losing those customers that they gained during the pandemic. The good news was that on the bottom line, results are going to be relatively strong. Instead of between $5.70 and $6.50 in earnings, management expects $6 to $6.40 in earnings. So again, the bottom line looks pretty good. Margins are still relatively strong. They're controlling operating costs, so that's a positive. But that pressure on the top line is really what I got to be concerned about for Best Buy long term. Now, if we go over here to the snapshot of the valuation metrics, you can see that the price to earnings multiple is 13.1 times the last 12 months earnings. On a next 12-month basis, the PE ratio is 11.6. Enterprise value to sales, 0.5 times. So that's a pretty good valuation. But again, like I said, revenue is on the decline. This is a look at some of the financial metrics. These are all last 12-month numbers, but you can see that in Q2 2022, and that is the fiscal year, revenue was over $52 billion. Net income was $2.5 billion. That has dropped really sharply to $44 billion in revenue and $1.3 billion in net income. Best Buy certainly looks like a value stock given a relatively low price to earnings multiple and a low enterprise value to sales. But the reality is that the business is deteriorating, and I don't know what's going to stop that. It seems like Best Buy is in a very similar position to what it was a decade or so ago, when there was a lot of competition in the market and things like online sales were starting to eat into the company's profitability. Now, the physical locations that Best Buy has just simply don't hold the same value for a lot of customers as they once did. And enterprise customers who value a lot of the services that Best Buy has, they're starting to cut back on their spending, cutting back on IT spending, cutting back on equipment that they're buying for employees, stretching out how long those assets last. People aren't building home offices like they once were. There's a lot of cutting back in spending that is hitting Best Buy at the same time. As a result, I just don't think this is a stock that is worth buying right now. I think it looks more like a value trap than a value. And until those operating metrics turn around and we at least see some positive numbers on a same-store sales growth, this is going to be a stock that I'm going to stay out of. But what do you think? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.